Hello, Vedivia community. Welcome back. Today is November 8th, 2023. I am Hammer here with your mortgage market update that we do each and every week. You can catch these on Wednesdays at 12 p.m. Eastern, 11 a.m. Central, 10 a.m. Mountain, 9 a.m. Pacific. And joining me this week, we have our special guest, Nathan Einkorn. Nathan is a mortgage broker out in Colorado. You like how I turned that into 4 syllables? And go ahead and tell us a little bit about yourself, Nathan.
Yep, I've been a loan originator since 2004. Currently in Colorado and VVA 4, and been in vetted VA since the beginning. Yeah, so ready to rock.
There you go. So we are here to answer all of y'all's questions. If you guys have any questions, please go ahead and feel free to post them out there. Give us a hashtag live in the comments. We are on Facebook. We're also on YouTube. So if you have questions today about anything we discuss, we are here for you. Go ahead and pop that on there. If you're here live, do go ahead and let us know. If you're watching on the replay, I know many of you do watch on the replay. Do us a favor, just put hashtag replay in the comments. We do monitor the posts, so we love to see that you are interacting and that you're watching. Also, if you have any questions from what we talk about today or any comments, feel free to go ahead and pop them in there. You can tag Nathan Einkorn as one of the moderators in the Vedivia community. He will be sure to answer you. And of course, you can always tag me, Hammer, and I will do my best to make sure that you're all squared away. So with that said, let's talk all about the rates, because that's what many of you come here to talk about and you like to learn more about. So we're going to talk about the rates today. Remember, this is not an offer to lend. And when we talk about rates, we're talking about averages and generalities. You always want to make sure that you are shopping around and that you're comfortable with who you are working with. So with that said, go back. There it is. Sometimes it goes a little forward. So what happened last week? Well, rates have dropped. And when I say dropped, it's pretty significant. In fact, Bloomberg even posted the U.S. 30-year mortgage rate tumbles by the most in more than a year, which sounds like amazingly exciting. So rates should be at 4%, right, Nathan?
Yeah, no. Yes. That's where they should be.
Yeah, well, yeah, but they're not. So if you did lock in, and that's actually one of the things I'm going to lean on Nathan to talk about in a minute is what, how to deal with it if you locked in October when rates were higher and what that conversation should look like. So right now, if you're out and you're not locked into an interest rate and you're being quoted rates today, you should find VA rates are generally going to be back in the high 6s to the low 7s. Conventional rates, meaning if you don't use your VA mortgage benefits for some reason and you get a regular mortgage, that's what we use. Generally, it's going to fall into what we call conventional mortgages. Those rates are averaging in the mid to high 7s. Nathan, you out in the field working with clients, does that sound right? Do those rates sound more, if somebody's getting rate quotes in that arena, does that sound fair?
Yeah. And those should be the rates that they should be getting without any, to be clear, without any buy down, right? Those are going to be the par rates that you should be seeing.
Yeah. So it shouldn't cost you much, if anything, to get those rates. And you shouldn't, sometimes you'll even be getting a little bit of a credit back from the lender in that scenario. So what about the forecast? Where are rates going from here? So we did see rates drop, and we'll talk about why they dropped. But as far as the forecast goes, for those of you that want to kind of jump ahead a little bit, the rates are not likely to drop too much further from here this week. We're going to be looking at some inflation data. It's going to come out next Tuesday. And if that inflation data shows that inflation has dropped more than expected, it could help rates to fall a little bit lower. Otherwise, we've seen a very significant rate drop. I'm not sure what the headline actually, contract rate dropped 25 basis points. And this all sounds really, really cool to hear it kind of put into this format. But what you're going to find is most of your rate quotes in the middle of October were highest in the middle of October. Right around the middle of the month, we saw mortgage rates that were pushing up into 8% on conventional mortgages, high 7s, mid 7s even for the VA rates sometimes. So rates were much higher in the middle of October. And now you're going to see that they're generally about 0.5% lower. And the reason that happened is that last week we talked about that we were at a crossroads and that we could see rates kind of go either way. We couldn't tell you which way they were going to go until we got all the data. We saw what the Fed had to say and how markets reacted to that. to all that news. So last week it did come in favorable, and we're very thankful for that. And what that means is that it could be pretty. We could be in a situation where the worst is behind us. Rates may have crested. Now, there's previous times that I've thought that they've crested and then they get a little bit worse. But as of right now, it's looking again like they may have crested. The reason for that is that markets believe the Fed is done raising rates. Last week's meeting, the Fed paused. They did not hike rates. It was the second meeting in a row. The first time in over 18 months that we've seen two pauses in a row. We had a previous pause, and then the next month they went right back to hiking again. So this time we have two pauses. And the Fed, by not raising that Fed funds rate, that doesn't necessarily directly impact mortgage rates. It doesn't change mortgage rates 1-to-1, but it does affect them. And basically, markets believe that if the Fed is done raising rates, that the economy is slowing down, the labor market is softening, that we're going to see a situation where the Fed will be forced to lower rates in May or June of next year. And right now we're kind of cresting. So, car loan rates, home loan rates, all that stuff should hopefully be finding its peak at this point and starting to pull back a bit. But if we go back, what would you say, Nathan, for somebody that did lock in an interest rate a couple of weeks ago, maybe it's, 0.5% higher. How do they want to handle that? What should they do?
Well, there's a couple options. The first one is talk to their loan originator about the float down policy, right? A lot of lenders are going to have it. It's different from lender to lender, so it does depend on who you're working with. If some lenders, the rates haven't dropped enough for them to initiate that float down, or even if the float down is available, it doesn't always make sense, right? So one of the advantage, and I'm gonna pat the broker community on the back here a little bit. Obviously, I'm very biased in that. But if you're working with a broker, your broker has the ability to take that loan to another lender, right?
Depending on
how much time. Yes. Do you have enough time? If you're closing if you're closing Friday, nothing you can do. If you're closing in 10 or more days, you may still, and you have a complete file. I mean, it's a case-by-case scenario, so I really can't give just blanket advice on that. But it is one of the advantages as a loan originator. And your broker should probably have already discussed this with you, right? If they, it's not something we want to do, but it is something that we can do. And with the significant, I mean, it is a pretty significant. It's almost half a point, like you were saying. We had buyers that paid a point to get down to 7, and now 7 doesn't cost anything, right? Yeah. Or now that same point gets them to 6.5. So and that's just on a $500,000 loan. Half a point is huge.
Let's break that lingo. So by paying a point, hold on, I got it on here somewhere on one of my things. So a point is 1% of the loan amount, and you don't always have to do it in full increments of a point, but if you paid a discount, if you paid a fee, you're paying a fee to get a lower interest rate. Let's say that Nathan used let's say a $400,000 loan. So let's say it's a $400,000 loan. 1% is $4,000. 2 weeks ago, you may have been paying, 1.1%. So $4,400 to get to the same rate that you may get today and not have to pay that $4,400. So that's one scenario that could be happening right now, is that you don't have to bring money to the table that you would have brought a couple of weeks ago. And that could be thousands of dollars. The other thing is maybe you weren't paying any points last time, but maybe the rate was, like I said, it could be up to 0.5% higher. And, if you locked in, when you locked in that interest rate, it protected you from rates getting worse. And again, as I'm a forecaster, this is what I do. I follow things, I track things, but there are times when we say, hey, the risks favor that you need to lock, because with that, we don't know that it's going to get better, and it could get worse. So a couple of weeks ago,
and if we've learned anything from the last 18 months, it's for the most part, it's gotten worse. So a lot of us are leaning towards hey, if you like it, lock it. That's it, right?
Yeah, very, very much so. So it's important to realize your bank, your lender, your mortgage loan officer, none of these people are trying to cheat anybody. The reason that we've seen so much of these moves is all the fancy charts that I like to show you guys here. And it's actually what's happened on Wall Street, what's happened with the 10-year treasury yield. A couple of weeks ago, this 10-year treasury yield in October touched 5%. That was a catastrophic number. And it was only there for a little while, but it's dropped significantly. This is what has driven mortgage rates down. The fact that the 10-year treasury yield has dropped, and that influences other investments, including mortgage bonds, which have improved. And that is what helps mortgage rates. So again, without going too deep on all the fancy charts, the bottom line here is that nobody is cheating you. If you locked in an interest rate, it protected you. The downside may be that you may not see today's rates, or you may not get those other benefits. Now, most lenders, though, they're going to recognize that you could pull your loan and go somewhere else, depending on how much time you have. And they're going to be aggressive to keep your business. And if you talk to your loan officer, your mortgage professional, like Nathan's on your side, especially veterans, right, Nathan? I mean, not that you wouldn't want to help anybody, but I know that you're very passionate about the vets. And as such, Nathan is going to do everything he can to help you and to give you the good advice. How much time do you have before closing? How difficult is your loan? Some loans are harder than others, and you may have situations in your loan that mean maybe we can't move that to a different lender, right? Or if you don't work with Nathan's a true mortgage broker. For those of you that don't know, there is a difference in our industry between what we call a mortgage broker and a mortgage lender. And a lot of times people use a blanket term mortgage broker, but a true mortgage broker is an active, I'm looking for the right word. I can't get, but he's the party is the word I want, that is actually shopping your loan and working with different lenders. And that's why he says he could move your loan. He could take it from one lender, move it to another if he has to. If you're working with a bank directly, or if you're working with a mortgage lender, they may not have the ability to move the loan. They may be doing the loan, as we call it, in-house. But that loan officer, that person, your mortgage professional, they're still going to be your advocate, and they're going to work with their management team and their back office teams. And oftentimes when you work with them, they're going to work to try to get you a better situation, maybe a better or lower interest rate if they can. That's why you want to ask them, what is your float down policy, and have that conversation. Now, if you're not comfortable with the answer, or if you want a second opinion, that's what the Vet VA community is for. Feel free to come in and ask the moderators, give them your scenario. It is complex, though. It's hard to take all that and put it into a Facebook post, and for Nathan to be able to give you an answer. But if
I would just want to say something real quick too. And it's not your individual loan officer, right? I mean, that loan officer wants to close your loan. He wants to help you. He wants to get you everything.
They're not going to make any more money because they're at a higher interest rate 2 weeks ago than we were today. They make no more money.
If they could give it to you, they absolutely would. So I don't fault, everyone chooses their business model based on, their personal decisions. So it's one of the, like, some people, I've had clients be like, I can't believe they were doing that to me. And I'm like, they weren't doing that. It's not a personal thing. That's just kind of the way our business runs. Certain lenders are captive, like insurance, right? They're captive agents. There's brokers, kind of the same thing. If those guys can only offer their products, whereas the brokers are able to shop. So.
Exactly. So, again, we do know that rates have dropped. If you were locked in the middle of October, that was when we had hit the worst levels. You may see a significant savings today. You want to ask them, we put on the screen before, about what is your float down policy. You want to talk to your particular lender, and you want to be careful about the idea of moving your loan yourself. If you've got your loan in with a lender and you move that loan, it can have a lot of repercussions. It could affect your closing. There's a lot of things that could happen. So I wouldn't be in a hurry to do it.
Especially if you have what we would call a sticky loan, right? If you know this, right? If you as the borrower, if you've had to jump through some hoops, you've got credit issues, you've got old collections, or there's just a lot of bones to your loan. You don't want to move that loan, right? Manual underwrites, one-time close construction, things like that. Like those loans, you got to keep wherever you started, keep them where they're at, right? Those are not loans that you want to start over somewhere else. stick with your because also these rate improvements for those lower credit borrowers, right? For those higher risk borrowers, like if you're in the 580s, this half a point improvement that we're talking about. These are for well qualified borrowers also, right? That 580 client, you might see an eighth of a point better than what you were.
You might not
before, because you're still high. You're still high risk, and an eighth of a point. We're talking about on a $400,000 loan. We're talking about $27. So it's not.
And the other thing too, let's talk about somebody right now. Let's say that you're close to closing, you have a sticky loan, any of these scenarios, and they're not able to negotiate the rate. Before I get to that, the last thing I want to put about negotiating the rate or changing the rate or floating down, if you see interest rates have dropped, like we said, to the high sixes. But if you're able to go from 7.5 to 7.25, and somebody new would get 7, that happens too sometimes. Sometimes they can come down some, but they can't give you today's rate. But because again, this is a complex industry, and I don't want to confuse everybody, but the brokers, the lenders, as they're locking in your loan, they're promising that money forward into Wall Street securitization. There's a whole, this is not just like somebody says, okay, I'll do that. This is a big deal. This is all promised money. So sometimes they're going to make less money. They're going to have to adjust to give you that little bit of a better rate. So almost like they'll split the difference with you. And that's perfectly okay. And it's ethical. It's more, and it's fantastic because I'm going to talk about back in my day with the dinosaurs, when we wrote applications with dinosaur bones, when a lock was a lock. We didn't have such things as what we call float down policies. Markets were not necessarily quite as chaotic as they are today. But when you locked in your rate, it was a commitment. This is like I gave you my high school ring. This was a commitment that I'm going to give you that rate, and you're committed that rate won't go up. But I also, if the rates go down, that's your commitment that, hey, we're locked in. Once it was done, it was done. So don't get, we've gotten kind of a society where people feel entitled to, well, I want the improvement, but I don't want the risk. That's when you lock in, you're avoiding the risk, but you're also agreeing to take those terms. And that's, keep that in mind. So,
and moving your loan is the last thing anybody wants to do, right? I, as your broker, I don't want to move your loan to another lender. And my lenders don't like it when I do that, rightfully so. Like Helmer said, when we lock a rate, I mean, that money's been earmarked, and now somebody else can't borrow that because it's, locked in for your loan. I always tell my clients, when you lock a rate, right, you're both making a promise to each other. Now, let's be real, right? The banks don't need that much protection. We're not out for them. But like Helmer said earlier, you're protecting yourself. If rates go higher, the bank is telling you, hey, you locked it in, so we're going to honor that. They're also hoping, hey, if rates get better, you're going to stick with us. Now,
and then so now let's say, because of that sticky scenario, because of anything, let's say that you're closing at rates from 2 weeks ago, and those rates are higher than where we're at today. Or let's say, again, hopefully people aren't paying a lot of points. We've talked about it in this market that we think rates are going to come down in the future. We're not big advocates on what we call permanent buy downs. You have to decide on your situation with your mortgage professional. But, and this is the reason why, again, why we've leaned against these. I did not see it coming where we saw this severe. I didn't think we'd see a rate drop like this. I generally said it'd be about 0.25%. This was much a bigger response than I expected. But let's say that you're stuck and you are at a higher rate. Well, this is the beginning of moving in the direction where rates improve. And we think rates are going to improve gradually over the next 12 to 18 months. And that means if you did close at this terrible interest rate, what options does somebody have in 6 months or a year?
Refinance.
Yeah. And I got it on the screen. I'm giving you the softball. Talk about it.
So, with especially specific to veterans, right? The VA IRRRL, with the interest rate reduction refinance loan, it's a streamlined process, right? There's no appraisal, very little documentation, no cost, and at a minimum, you have to save at least 0.5 point on what your current loan is. You have to be in your loan for 6 payments or 210 days, but that is an option. The main thing is, going back when you're talking about hey, you're closing at this terrible rate. The one thing that hopefully you have a good mortgage professional that you're working with, the payment that you have is something you're comfortable with. And that's the main thing I would tell everybody that's doing a loan right now. Make sure you're comfortable with this payment. If someone's selling you on this future refinance, run away, go work with somebody else. You need to, you need to buy this loan, buy this home as if this is going to be your payment for the foreseeable future, because none of us have that crystal ball. We can all talk about all the things, right? We got an election year coming up. We've got just absolute chaos going on throughout the world, which these two things, I mean, historically speaking, I hate to say it like this, but those two things happening are good for mortgage rates in a normal world, but we just don't live in that anymore. So the main point is, like, if they're selling you on a future refinance, the date, the rate, marry the house crap that I just, sorry, language, do your due diligence. Make sure you're working with a true advisor that's helping you and putting you into a good situation, and buy as if this is going to be your payment, knowing, keeping that, that arrow in your quiver that, hey, later on down the road, when rates get better, we do have the option to refinance. So, and
exactly, I agree with all of that. But the one thing I'm going to emphasize though is, if you did lock in and you do have a rate that's higher than what you think you'd get today, you're not going to have that rate forever. You want to be able to afford it. You want to make sure that you live as if you were stuck with it forever. However, my job is to tell you that it's unlikely that you will be. 12 to 18 months from now, we're likely to see rates continue to move lower. Maybe not significantly, but you'll have opportunities to lower. And the VA mortgage has one of the best opportunities with that, where it gives you the opportunity, if you're not taking cash out and you're not doing these things, but it's just an interest rate reduction, then that's going to give you that opportunity. So keep that open. Keep that in mind. You don't want to let that let you get cold feet on buying a home today, because the rates have dropped and you feel like, oh, they're going to keep dropping. It's not likely they're going to keep dropping. In fact, let me go back to the screens and we'll kind of finish up for the day here. So going back here, my forecast is that, first of all, I want to just give everybody what's affecting rates. The Fed. Markets believe the Fed has been raising rates, although the Fed officials are sharing mixed messages about that. They're kind of leaving the door open. Markets are also anticipating the Fed's going to have to start cutting rates in May or June, when the economy shows signs of slowing down and if the labor market softens. And that's when we'll see rates improve over time. The forecast over the next 15 days, rates look very likely to hold steady. I was concerned we were going to see, after we see a huge improvement like we did, very unexpected. Generally, there's a bit of a rebound. On Monday, we saw rates get a little bit worse than when we ended the day on Friday, but they've really held since then. And it's unlikely that we see them go up they shouldn't jump, but they may creep a little bit. They're going to fluctuate a little bit. Next week, we're looking at that inflation data. If it's good, it could help improve a little bit more, but again, not likely. This is not the avalanche where rates drop to 4%. That's not going to happen. The next few weeks, rates are going to fluctuate, but it looks like the worst could be behind us. Hopefully, let's keep our fingers crossed. And then longer term, rates are still not going to move significantly lower until 2024 sometime, when it's more likely that the Fed is going to start cutting the Fed funds rate and the economy is slowing and all the other stuff. So keep all of that in mind. I do see a comment. Let me just take a look and see.
I was just going to say, I saw a question that...
Yep. Yeah. Do you believe in the next 18 to 24 months rates will get back to 4% or below? No, I don't. But I'm going to, go ahead.
I don't think we'll ever see that. I think a realistic goals for people to look at is rates. Now, granted, could you buy the rate down to 4%? That may be available, like in 24 in the next 18 to 24 months. But I think as far as par interest rates are concerned, I don't think we're going to get lower than the high mid fives. I think would be like amazing if we see that in the next 2 years.
I think that it could get into the low fives or even the high fours. I will say that. Right now we have a very large, and here's the technical answer to this, even though the technical stuff is kind of put you to sleep, but we have a very large margin between our 10-year treasury yield and our mortgage-backed securities. It's a much larger margin than normal. It generally averages about 180 basis points. It was over 300 basis points. It's down a little bit from there recently, but in other words, that 10-year treasury yield and mortgage pricing, it shouldn't be as far apart as it is right now. I think that's part of it. When the economy starts to slow down and jobs slow down. Now, if we see a true recession, if people are losing their jobs, if inventory increases, all these different things coming into play, that could help bring rates down even further. But ideally, the Fed does not want to drop rates to zero. That was what they had to do during a pandemic. And hopefully we don't see another pandemic. We don't see our economy shut down, our country shut down, that kind of a thing. So without that kind of black swan event, I would say in the fives, but I think that there is room for that. It could go a little bit lower. In 2017, I got a rate of 4 1/8. That was what we would call a more normal market. So we could be in the high fours if things kind of slow down, depending on where they go. So, but either way, one thing I'm going to throw that caveat is I can't tell you what rates will be next week, let alone 18 to 24 months from now. So that's my opinion. 2 years ago, a year and a half ago, we did not think we would ever see rates in the sevens, let alone the eights. And we were calling for rates to be in the fours now. And yet here we are with 7 and even 8% interest rates. So, just keep that in mind. We do our best. I give you the reasoning behind it, but it's you always want to make decisions based on the data you have today. Like Nathan said, you need to make sure you can afford what you're getting today. And it's still a great decision. So, but you are welcome. That kind of runs us out of time here. I'm going to wrap it up. Nathan, is there anything you want to leave everybody with?
No. I mean, just with where rates are, with the market, with everything that's going on, just stay in communication with your loan originator, with your realtor. Just make sure that you are in constant contact, because things are changing that quickly, right? I mean, someone who had a conversation on Friday, it's a completely different conversation on Monday. I mean, it's crazy how quick all that changes. So, just and keep asking questions, right? Use the community, use the moderators here in Embedded VA. We're here to answer those questions for you. There are no dumb questions. Please keep them coming, because we want to help, and we want, our goal, our mission, Chris's mission, and Nate, when they originally started this, was we want to get as many veterans as we can, active duty, into homes. But we want to do it the right way. We want to do it responsibly. We want to make sure that it makes sense for you, and we're setting you up for success. So.
Very good. Well, thanks again for joining us, Nathan. Everybody, I'll see y'all next week. You guys know where to find us every Wednesday, and I'll see you then. Take care, everybody.